Yes, today I'm going to give you a quick little visual of what's happening in the mortgage market, specifically with regard to interest rates. And kind of, we all know the old adage with real estate. When we're talking about real estate values, it's a pretty simple formula, right? It's location, location, location. And we hear that all the time, and that's because it's true. It's a cliche, but it's true. And that's kind of what you focus on in real estate. And of course, things do influence the general trends. But those are really the three factors when you're valuing real estate. When it comes to interest rates, it's jobs, GDP, and inflation. And that's really the three things that you have to be on the lookout for right now. And that's what's making it such a tough job for the Fed right now to kind of communicate, to telegraph where they expect rates to be. Of course, throw in the election year, and that's going to create extra volatility, especially when you factor in that they have long indicated that they do plan to lower rates. They're starting to approach that inflation target that they want to get to, but they only have so many meetings to do that in the coming year. And the closer they get to the big election that we have coming up in November, then the more their motives will be questioned. And so it really does kind of compress their timeline. But they really do want to kind of balance those two objectives of keeping inflation in check, getting to that inflation target, and then also lowering interest rates and reducing some of the pain we've all been experiencing in the real estate market and the housing market. And so, this is a graph of what's happened. Basically, you see this kind of going back to, maybe fall, early fall, late summer of 2023. And you see that we had this continuing rise up, and that's just something that's been going on for the last couple of years. And we kind of hit near this 8% mark. We got to this is national average, 30-year fixed rate. This is just 30-year conforming interest rates. And we got pretty close to that 8% mark when we hit November. And then what happened? We started to see some favorable reports. And these not just one-off reports, but this was kind of collectively, they all kind of started to come together to coalesce. The jobs report, the GDP reports, and that's gross domestic product. That's the overall productivity of the economy. And what happens is when you have a robust jobs market, you have a high productivity, those tend to create inflation. They tend to go hand in hand. And so Fed is looking for weakness in these things. And we started to see a little bit of weakness during this period here. So we got, kind of peaked out here near November of 2023. And we started to come down fairly markedly. You see, we were kind of near 8 here and we got below 7. So almost a full point in the course of, let's say this is, 6 months or so. And that's a pretty, that's a pretty impressive decline rate. That's going down pretty quickly. We're all excited about that. And then what happens here? Then we kind of flatten out. And what happens here is we started to get moderately testy reports. Nothing that was really gonna kind of knock the wheels off of the Fed's bus of driving toward lowering rates. They were still communicating, yes, we're kind of liking what we see, but they're very cautious, always equivocating. And always being careful not to signal to the markets, okay, it's all bets are off, we're going to start lowering right away. But the market was predicting that lower, those Fed rate reductions were coming soon. And so even though we started to get economic reports here that were contradicting that were suggesting that maybe the data, because that was a key word for the day, key phrase for the day for the Fed. They kept saying, oh, we're going to watch the data. It's data dependent. And so the data during this period of time was no longer obviously positive for a Fed rate cut. It was maybe neutral, maybe slightly contrary to that. So we saw the market start to flatten out during this period of time. Well, then we got a big surprise on the first Friday of February. The first Friday of every month is the Bureau of Labor Statistics non-farm payroll. We get the non-farm payroll report the first, and that's extremely impactful in almost every market. It doesn't even have to be the hyperinflation sensitive market that we're in right now, but in any market, that jobs report has a huge potential to move the market positive or negative. And what moves it is not so much the absolute number itself, but how it performs compared to what the market was expecting. And the market was expecting somewhere around 170,000 and got almost double that. And that really, and you're really not even seeing that here because, we're not seeing the impact of that yet because this graph kind of cuts off before the impact of that. And now we're not going back to here, at least we're not there now. It's not like it knocked us, it gave away everything we gained over the last 6 months. It didn't, but it was a fairly stiff surprise and a reality check And it does suggest that the Fed's hands are going to be tied and they're going to have to delay further when that rate cut's going to happen. And so that is kind of where we are. Now, what are you to do as a buyer, as a potential shopper? I would say keep your powder dry. Yeah, and stay in contact with your mortgage lender, stay in contact with your realtor, be in the lookout because there's a whole number of things that are happening. There is more inventory coming on. We did turn the corner kind of around, both the holidays and then the market itself with rates starting to come down right kind of through those holidays. And so we are seeing people that delayed or came off the market last year starting to think about coming back on or actually reaching out to the realtors, putting properties on. We are going to see some more inventory. So keep your powder dry, stay ready to buy, and work with a lender who can close really fast. Because what you want to be able to do is in this market of somewhat volatility, it's not been it's not been erratic or extremely volatile, but there's enough volatility where if you need to work with someone who needs 45 days to close, you may not know what your rate's going to be by the time you get there. So work with a lender who can close fast, who's got competitive pricing, who can get you fully ready to go and prepared, and then work with a realtor who's got their pulse on the market and stay in touch with them because when that right property comes along, then you can, get an update. Where are rates right now? What's this going to cost me? And maybe that's just going to be the right moment in the marketplace for you to execute. I still do expect rates to come down over the next several months. I think the Fed is very committed to that. They will be under an extreme pressure to do that as we get deeper and deeper into this market, deeper into the election season. They're going to be under extreme pressure to do that. But I do think also they're going to be challenged by some of these numbers. We may still see inflationary pressures that challenge their ability to do that. So overall, the market is definitely pricing in rates coming down, and I do think we're going to see that. But I think it's going to be a little bit of a choppy ride. So anyway, that's it for now, and let me know if you have any questions. Thanks so much for watching.